Okay, so in the current case, we will understand that there are how many types of accounts. Okay, followed by that, we will understand that what type of balance we have for each of the type of accounts. Okay, so those balances will be default balances for those accounts. And in a nutshell, also, we have only five type of accounts throughout the accounting as a subject. Okay, so I am classifying the similar accounts which will have similar default balances. Okay, so you can write down this because it is one of the golden rules in accounting to classify, or we can to understand the balance of account. So there are five type of accounts, as initially I have said. First is assets, second expenses, third is liabilities, second is capital, and then is revenue. Okay, so asset and expenses will always, and when I say always, it means 99.99% will have debit balance. So there is 0.01% chance that it will have credit balance. It's a very rare case, and the rare case is, I will let you know, followed by the explanation. Okay, so asset and expenses will have debit balance all the times. Okay, except for rare times. Liabilities, capital, and revenue will always have credit balance. Some of you may think that why don't liabilities, capital, and revenue will have debit balance, and vice versa. So because this is the methodology, okay, the accounting practitioners have adopted. Okay, so we will not pose logic that how, that why can't we reverse the position of the balances for liability, capital, revenue, and asset and expenses. Okay, so we will not give much attention to that, and we will generally just mug up it, because in practice this concept will be relevant for us. Okay, we will deal with logics when we will face practical problems. So these are the five type of accounts we have, and followed by that we have the type of balance in default for each of the account. Now what happens in a business? In a business, there is a general statement every accountant prepare. Okay, so business is actually established to earn the profit. If there is no profit, so there will be no use case of the business. Okay, so this is mostly the credit side, and this is mostly the debit side. So we have just seen on the debit side what we have expenses. So this is the statement an accountant generally prepares, okay, to arrive at the profit or loss made at the end of financial year. So sale of goods and services, and this is the revenue side, which comprise of sale of goods and services in which business entity deals. Okay, expenses could be raw material, and likewise. Okay, okay, so now what happens when accountant writes all of the items under debit side as well as credit side. So the accountant does not understand this relevancy, so it transfer all of the items in this statement to income summary account, or we can say income summary only, not income summary account. Okay, income summary, to arrive at the profit or loss made at the end of financial year. Okay, so we have understood this, that at the debit side we will record our expenses, what we have incurred to earn the profit, and at the credit side we will write the sale items, that what amount, for what amount we have sold our goods and services to our customers, and all of the items in this statement will be closed, or we can say we will transfer all of the items to income summary. Now what happens to transfer the amount, what happens if the revenue is having a credit balance? Okay, so every item on the credit side will be debited. Let's not write here. Okay, let's write here, and you can also write it down so that it will be better for your future reference. So I'm writing with a green pen. Okay, for closing. So to close the items on the credit side, we will debit those items and give a corresponding credit to income summary. Is that clear? Okay, and to close the items on the debit side, we will credit those items and give a corresponding debit to income summary. It is just the opposite of what we have done. Okay, so we can also write it here, like, let's say suppose asset and expenses are having debit balances. So I'm writing down with the red pen that what we have to do to close down the accounts. Okay, so we will credit the asset and expense and debit the income and summary to close the asset and expense account, and we will debit the liabilities capital revenue accounts to close down to the income summary. Okay, so what we have in our solution also, so our solution for current question matches with choice D. Okay, so to close down the fees earned, okay, we will close down to the income summary. Okay, because all of the items in the statement will be closed down to income summary at the end. Okay, so that solution matches with choice D. That's all for our solution.